Hi class, good morning. Welcome to our week 7 in technopreneurship. So our topic for this week is all about the forms of business entities, regulations, and business support system. After the discussion, you are expected to distinguish the different types of business structures organized under the Philippine laws. Recognize when a contract has been formed and determine whether it is a valid and enforceable. And reinforce students' understanding of the differences in establishing the business entities using the sole proprietorship, partnership, and limited company. The business entities. If we say business entities, this addresses all the major forms of the legal entity, the basic principles, requirements for selecting an entity, and the legal entity management. So in other words, this is the process of incorporation of a company. So the types of business entities under the Philippine law. We have the sole proprietorship. Sole proprietorship is the simplest and the least formal type of business arrangement in which a single entity has the full ownership and control over the company. So the pros or the advantages of having the sole proprietorship, we need to enjoy all the profits of the business. So the owner enjoys all the profits of the business since it is the only one who owns the company. So he enjoys all the profits that the business accrues. And then the second one, we have the quick decision making. So when it comes to making decisions about changing the type or the quantity of commodities that the business detail, you do not have any person to consult on, so you have a quick decision making. Next is easy to manage. As a single business owner, it is easy to a manager to manage the business since there is no bureaucracy that you have to follow when making decisions. Next is flexibility. This applies in terms of changing the commodities that you sell. You can change them anytime you feel like, as long as it's general sole proprietorship with the freedom to sell any product. Next is easy to start. So yes, this business type does not have a very long preparation or legal procedures to follow before it gets established. So one of the disadvantages of having the sole proprietorship is the owner incurs all the losses. So in case of losses, the sole proprietor bears all the burdens solely. Next is unlimited liability. So this means that in case that the business runs bankrupt, the assets of the business owner will be sold to clear all the debts. So the business owners pay the personal income tax on the business net profits. So in taxes, so you have your personal tax identification number for your proprietorship. So the income tax of your business follows a graduated rate, meaning the higher income you make out of your business, the higher income tax you will have to pay. So that is sole proprietorship. How about partnership? The partnership in the Philippine Civil Code recognizes a corporation as the legal entity, which ensures that the legal entity is distinct from the business owner. So under the Civil Code of the Philippines, a partnership is regarded as the legal entity with a distinct legal identity from that of its members. So meaning that partnership can be either a general partnership where the partners have the unlimited liability for the debts and obligations of the company, or limited partnership where one or more the general partners have the unlimited liability and limited partners are responsible only up to the value of their capital investment. So it consists of two or more of its partners. So actually there are two kinds of partnership. We have the general and the limited partnership. So in general partnership, business partners share the unlimited liability for the debts and obligations of the company. On the other hand, if we say limited partnership, uh, these are called as such time since some partners will have the unlimited liability while others will have the liability which is equal only to the amount of their capital contribution. So if your partnership has the capital that's worth more than 3,000 pesos, you will need to register it with the Security and Exchange Commission or the SEC, and the Philippines allow the foreigners up to 40% of ownership in the partnership. So these are the advantages, disadvantages, and the taxes we have for partnership. So easy to start. Forming a general partnership usually takes a short time since it does not only involve the legal procedures, which requires a less capital. So the amount required to that of a partnership is not equal to the amount you need to start a company. So the amount of profits are shared according to the ratio of the capital contribution of each partner. The higher the capital you contributed, the more the profits you must enjoy. So we also have the consultation. Good thing with partnership is that before arriving at the final decision, there is always a consultation between the partners. This leads to a better decisions that improve the business. Next is the quick decision making. A partner owned and operated by two people is easy to make decisions that can enhance the performance of the business. You don't need to call for a meeting to discuss the arising issues. Just a phone call is enough. And then we have these disadvantages or the cons. Unlimited liability. General partnerships means that both partners have unlimited liability. So in the case of the corporate debts from the company is unable to cover, the personal properties of the partners are at risk by being sold in order to clear off the debts. And then we also have the internal wranglers, which is often a number of relationship collapse because of the internal disputes or the personal interests of the particular partners. So the partners are burdened by paying the additional income tax on the company's net profits. In terms of taxes, partnerships are taxed just like corporations. So the basic income tax applied to partnership and corporations include the regular corporate income tax or the RCIT, which is the annual tax paid based on the taxable income, the minimum corporate income tax or MCIT, which is the tax to be paid on the fourth taxable year of the business if the MCIT is greater than the RCIT. And then we also have the improperly accumulated earning tax such as IAET. wherein the tax paid if the accumulated earnings exceed 100% of the paid-in capital. Corporation. If we say corporation, these are owned by a total of 5 shareholders and a maximum of 15. All of the shareholders must own at least one share of the company, and their liability is limited only to the value of their share of shares. So the liability of the shareholders of a corporation is limited to the amount of their share capital. So throughout the Philippines, a company is legally regarded as separate body and distinct form from that of the owners who own the company. So the company should be licensed in the Security and Exchange Commission with a minimum paid up capital of 5,000 pesos. A foreigner can have the 40% ownership in the company. So there are kinds of corporation. We have the stock corporation, wherein the capital stock of the corporation is divided into shares, which are distributed to investors. In return, the investors receive the dividends and the part of the surplus profits computed based on the number of shares they hold. And then we also have the non-stock corporation, wherein it does not issue share of the stocks to its members, since the entity exists for charitable, educational, cultural, or other equivalent purposes. So these are the pros, the cons, and the taxes we have in corporation. So one of the most appealing features about the company is the limited liability of its members. So it ensures that in case of bankruptcy, the properties of the lenders are very secure and remain unaffected by the creditors. There is a possibility of lowering taxes, particularly if the owner and the company share income. At a certain times, benefits may be deducted as business expenses. So it is easy to pass the ownership of a company, which means that in the event of the current shareholders or the directors expect a dark future, they will sell the company and thus avoid losing their capital investment. So disadvantages includes very expensive compared to setting up a simple business setup such as the sole proprietorship and the partnerships. So starting a corporations involves a lot of paperwork. So when it comes to legal paperwork, the owner must file with the Secretary of State. So a corporation operates as a separate legal entity, and hence it is entitled to pay taxes such as the partnership that I have mentioned on the other slide. So there is a slow decision making in the corporations, since the directors have to be consulted before any verdict is reached. The basic of business contracts and agreements. So in addition to being clear and specific, a contract must meet a certain criteria to make it legally enforceable. A legally enforceable contract can be used to court to support a decision on a disputed item. So if a contract does not have a certain essential ingredients, it is not legally enforceable. So many contracts would never be seen in a courtroom. So and may simply be a verbal unless there is a clear reason for the contract to be in writing. So when something goes wrong, all the parties are secured by a written contract. If one party to a valid or enforceable contract believes that the other party has broken the contract, Infringing the legal term, the party to the contract may bring a lawsuit against the party to which it is a subject. So the legal procedures or arbitration shall decide whether the contract has been infringed or whether there are circumstances that mitigate the infringement. So the court can, however, hear a contract dispute only if the contract is legitimate. The basic of business contracts and agreements. The Black Law Dictionary describes an agreement as a shared understanding between the parties of their respective rights and responsibilities. It defines a contract as an arrangement between the parties specifying the obligations that are enforceable. So each contract must contain a specific offer and accept the specific offer. Both parties are required to consent to their free will. So neither party can be coerced or forced to sign a contract. And both parties must agree to the same terms and conditions. So the intentions of the parties to establish a contractual agreement is to indicate in these three conditions: if one or more or both of the parties is not serious, there is no contract. How about the Partnership Act of 1961? So the Philippine Partnership operates under the concept of the unlimited liability and unless otherwise agreed upon by the partners. So each one of them act as a manager and agent of the partnership, and consequently, their act bind the partnership law. So the Philippine law allows the dissolution of the partnership for any reasons which provide such dissolutions does not amount to a breach of contract or it is prejudicial to the third parties. So in other words, any change in the composition of the partnership, unless so allowed, will result to the dissolution thereof. Consequently, the remaining partners may form the new partnership with the less or more partners. The private limited company. These are the private companies that do not raise capital by selling shares to investors close to the founders, banks, and funds that directly invest in private companies. So a privately owned company has more flexibility in how it works as it responds to a fewer bosses than a public one. So the party with the money on the line is limited and picked. A private corporation does not have to provide the specific information about how to perform the financial and government investigation as to do the public corporation under the regulations of the Security and Exchange Commission. So the advantages of private limited company, we have the limited liability, tax advantages, finance and resources, and business continuity. For limited liability, according to Apex, these are treated as the single entity making the company responsible for all debts. If we say tax advantages, these are the companies pay corporation tax on their taxable profits and tend to be exempt from the higher personal income tax rates. For finance and resources, we have to retain more funds within the business to meet the future financial commitments, which aids year-on-the-year growth. And then we have the business continuity, which enjoy the permanent succession because the company is its legal entity. The disadvantages of having that private limited company: the profit sharing, the taxes, no trading, cost, lack of privacy. For profit sharing, the profits become diluted because it is not evenly distributed among the shareholders. The taxes: the registered PLC directors are expected to keep outstanding records of income and expenses, including the sales and spending. So this document must be maintained for at least 7 years and are used each year to complete the tax return of the corporation, wherein PLC would pay their employers' taxes and benefits. To say no trading, the owners of the PLC do not sell or pass their shares to the public at large, and the 50 or so investors comprising a PLC must maintain their shares and should not sell them on a stocks of exchange. For cost, the formation of the PLC can be very costly, as it pay only taxes and employee benefits, but also any legal costs or other incidentals involved in the company. So PLC can also be quite complex, meaning that lawyers and accountants almost or always need to be involved in the PLC from the start, which can be costly. So for lack of privacy, the account balances and details about the company's directors, including their names and contact information, must be made available upon request. To summarize the lecture for this week, we have the different types of business entities under the Philippine law, such as the sole proprietorship, the partnership, and the corporation. And we have to differentiate between the agreements and the contract, wherein agreements is a shared understanding between the parties of their respective rights and responsibilities, while contract is the arrangement between parties specifying the obligations that are enforceable. The advantages of the private limited company, such as the limited liability, the tax advantages, finance and resources, and business opportunity. While the disadvantages consist of the profit sharing, taxes, no trading, cost, and lack of privacy. For further readings, please read the references or visit the references that are included in this video for more information. Thank you and good day.